Chinese stocks tumbled in the worst start to a new year since 2016, while Indian stocks showed a recovery after pullback towards the end of last year. Investors are now bracing for economic risks for China as weaker than expected industrial data and also an anticipated rise in tariffs. Trump warned of 60% tax on goods from China. Beijing is taking measures to impose its own retaliatory plans in a bid to force Washington to negotiate and avoid a full-scale trade war. Beijing, though, is worried that further tariffs will hurt its already shaky economy. A new trade war with the U.S. would still hurt China more. After the tariff threat on Chinese goods, market observers noticed that funds were already moving into India and Japan. That outlook is already starting to play out in the new year. China's CSI 300 index closed 2.9% lower on Thursday, its steepest drop on a year's first day of trading since 2016. The Hang Seng China Enterprises Index slid as much as 3.1%. Indian stocks, though, recovered majorly, with bulls extending the New Year party on D Street. The benchmark blue chip Sensex index surged over 1,400 points, and the broad Nifty 50 gained about 2%. Veteran emerging market investor Mark Mobius said, and I am quoting, "Supply chains have been moving away from China, and that helps not only Japan and India, but also other countries, particularly in Southeast Asia." He said India is the big beneficiary since only India's workforce can match the Chinese in numbers and labor cost. He added, with Trump maintaining or even extending trade restrictions on China, this will be extremely positive for India. And well, for more on this, we are now being joined by Mithali Nikore. She is an economist joining us from Kolkata in India. Welcome to World Business Watch, Mithali.
Thank you. Good morning.
Good morning. Now, many on Wall Street bet that investment flows into India and Japan will perhaps increase at the cost of Chinese asset under Trump 2.0. What is your take for 2025?
So first of all, thank you so much for having me on the show this morning. And, this is a very interesting question which has been raised. We have to start now thinking about how the real economy is truly impacting the financial economy and financial flows, because this is a classic case of, the real economic changes, such as, a change in incentives like tariffs, impacting the decisions of different investors and saying, which is the market that's actually going to give me the safest return? See, in this case, nobody is doubting China's growth story. Yes, everyone knows that there will be a certain amount of slowdown in the Chinese growth. China has had many, many decades, almost 2 decades of continuous growth. Definitely it will taper down. But the fundamentals of the Chinese economy are also strong. Yet, because of this tariff story, there's suddenly a question over whether Chinese-made products will have similar access to the US consumer as an Indian-made product or a Japanese-made product, or even for that matter, products made in Taiwan. And Hong Kong, of course, hangs in the balance. So on balance, I would say that for Asian markets, besides China, the outlook is much more positive only because of the tone in which the tariffs have sort of sought to target the Chinese economy.
Right now, the Indian economy is broadly expected to slow this year. Will that perhaps have an impact on the narrative of India gaining on China +1 strategy?
So I believe that one of the growth drivers for India is going to be the manufacturing sector in 2025. I mean, we've seen that post-COVID, the government of India has been very bullish on the entire manufacturing story, bringing in a very bold reforms in the form of the production-linked incentive schemes. Because at the end of the day, this was not a widespread measure. It was not, in fact, taken very positively by Western markets and Western, trade economists, for example, who looked at the PLI scheme almost like as a way of saying, you're just trying to attract investors by giving some SOPs, and this is not going to be sustainable. But 3 years on, the production linked incentive scheme has brought in a lot of investments. And I do believe that even if there is a slowdown on the services side, India will make up for it with the manufacturing investments coming in.
I also want to seek your assessment as to what is your outlook for the Asian markets in 2025, especially with Trump in the White House in just maybe 15 days from now.
Yes, absolutely. I mean, we've already seen that the MSCI index has actually fallen by about 1 to 2% in the last, few days. On the other hand, the S&P 500 has seen a rise because by and large, investors are seeing this as a story of a strengthening US dollar, a strengthening US economy, more and more focus on job creation within the US, and therefore higher returns for dollar denominated securities and dollar denominated assets. So, therefore, there is a flight of capital, and we saw this in the last quarter of 2024. I mean, the last and the calendar year 2024, where there was a flight of foreign direct investment away from Indian markets and other Asian markets towards American and US dominated securities. So, definitely for the first quarter, we will see investors judging where is the US policy going. And then we'll be able to make a judgment for the rest of the year.
Right, Mithali. Thank you so much for joining us on World Business Watch. Always a pleasure to have you on the show here.
Thank you.